I'm Dr.V.Subhamathi, working as an Associate Professor, Department of Management Studies, Bharat Institute of Higher Education and Research, Chennai. Course code P20Mbec28. Subject name Financial Framework and Systems. In this session, we are going to discuss about RBI Act 1935, Reserve Bank of India Act 1935. RBI is now apex financial institution of country which is entrusted with the task of controlling, supervising, promoting, developing and planning the financial system. The RBI influences the management of commercial banks through its various policies, directions and regulations. Its role in banking is quite unique. In fact, the RBI performs the four basic functions of management like planning, organizing, directing and controlling in laying a strong foundation for the functioning of commercial banks. So RBI is also called as the Central Bank of India. So RBI is the completely apex financial institution of a country. So RBI has all the rights of controlling, supervising, promoting, developing and planning the entire Indian financial systems. So it has all powers. So RBI can control the banks, RBI can supervise, RBI can promote, RBI can develop. All the rights are responsibility RBI has its own. So that planning definitely it is needed for the Indian financial systems. So the RBI influences the management of commercial banks. So RBI is completely managing all the commercial banks. Bank means that bank should come under RBI. So the both public banks, private banks and NBFCs, whatever it may be. So all the banking industry should come under RBI. So RBI influences the management of commercial banks through various policies. It has many policies, procedures, directions, regulations. So its role is a completely unique for the regulations for the banks. And in fact, the RBI performs the four basic functions of a management. So RBI is planning everything for the banking industry. RBI is almost organizing, controlling and directing, monitoring, supervising. Everything is done by RBI. Without RBI, without registered under the RBI, there is no any banks. There is no any banks. So that is called as RBI. So it's laying a strong foundation for the functioning of the commercial bank. So without RBI, there is no a proper performance of the banks. So RBI is taking care of the entire banking industry in our country. RBI possesses special status in our country. It is the authority to regulate and control the monetary system of our country. It controls money market and the entire banking system of our country. So RBI is definitely it has the special status in our country, means that is the central bank of our country. Central bank of our country. So that is the special status it has there for the RBI. And it has the authority to regulate and control the monetary systems completely. Completely RBI is taking the responsibility and authority to regulate and control the monetary system, not only a financial system, monetary system also taken care by the RBI. It controls money market and the entire banking system of our country. So it almost taking care of the all the banks and all the money market instruments, whatever. So entire banking system of our country, it's under RBI. The management. There are two ways are there. One is central board and another one is local board. Central board means here governor and deputy governor. They are the taking responsibility for the RBI and banks. Local board means regional areas, represents all local financial problems. So here management means that means RBI how they are going to manage and regulate and control the entire monetary systems in a single hand, that will not be happen. It is a very big task. So that central board has decided to give the some of the regional areas as a local board for the RBI. So that region areas they are appointing some representatives to identify the financial problems in the local area. That local representatives are representing to the regional areas. That regional members he is representing to the deputy governor, and deputy governor is representing to the governor, and finally they are taking decision. So in such a manner they are regulating and monitoring the entire monetary system of our country. Governor are not more than four deputy governors. The current governor of RBI is the Mr. Urjit Patel. So he is the current governor of RBI is the Mr. Urjit Patel. So he is the taking the all the decisions whatever he want to take relating to the financials. And there are three deputy governors representing BP, Kannango, NS Vishwanathan, and V. Acharya. So these three members are called as the deputy governors. Nominated by the government, 10 directors from various fields and 2 government officials. So 10 directors they are appointing in all the fields. So related to the important fields that too, and 2 important government officials will be there for the program. And other 4 directors, 1 each from our local board. So 4 regionals, east, west, south, north. So basically, so they'll appoint the 4 directors in each local board. And central office where RBI is located. So central office of RBI located in Mumbai is divided into several specialized departments. So these are all the main departments are working under RBI. So first one issue department, second one banking department, third one department of banking development, fourth one department of banking operations, fifth one non-banking companies department, sixth one agricultural credit department, seventh one industrial finance department, eighth one exchange control department, ninth one legal department, 10th one Department of Research and Statistics. So these are all the 10 basic important departments that is under controlled by RBI. So RBI is definitely they are having a central office in Mumbai, but they are divided a different specialized departments. So issue department. So issue departments the main role is currencies exchanging. So they are issuing currency or they are issuing some notes or coins or currency in the public to the public. So they are is exchanging one among others. So like that is issuing. So how much money is to be printed? How much money is to be circulated among the public? So that department is taking care of the issue department. That issue department again coming under RBI. Next one banking department. We know about banking department very well. So the depositing and taking or giving the loans and advances to the public. That department is completely coming under banking department. Department of Banking Development. Banking department is completely taking care of the deposits and loans. But how to develop that banking industry? So that is for the completely one department is there only to develop the banking industries. Next one, Department of Banking Operations. So earlier if you want to transfer the funds means you need to go to the bank and you need to stand in the queue. You have to withdraw and you have to deposit whatever the things. But now it's fund transfer is very important and very easiest thing nowadays. So that is Department of Banking Operations. That operations is completely taking care of the Department of Banking Operations. Non-banking companies departments. Non-banking companies. So non-banking financial companies are there. So NBFCs, one department should completely taking care of the NBFCs. Agricultural credit department. So in our country is completely depends upon the agricultural activity. So without agriculture in our country we cannot do anything. So for that, to maintain that agricultural activity, one department is specifically is the agricultural credit department. Industrial finance department, as many of them are now starting their own businesses. So for them, they need money. So at the same time, RBI has they want to develop the industries too. So for that, industrial finance department is separately they are maintaining. And exchange control department. So exchange control department. So money exchange from foreign currencies or Indian currency and other currencies, whatever. That exchange department is particularly different. And legal department, and last one is Department of Research and Statistics. How much we are printing, how much it is circulating, how much we are getting back in the different forms, what would be the requirement in the futures, everything that is come under Department of the Research and Statistics. Introduction. The RBI, as the central bank of the country, is the center of the Indian financial and monetary systems. It started functioning from April 1 to 1935 on the terms of the Reserve Bank of India Act 1934. The act was in the year of 1934, but it started functioning in the year of 1935. The bank is managed by a central board of directors, 4 legal boards of directors, and committee of the central board of directors. So RBI is also called as the central bank of the country and the center of the Indian financial and monetary system. So Act was released in the 1934, but the functioning was started in the year of 1935. So 4 central board of directors will be there and committee central board of directors will be there in the RBI. And main functions of RBI. So first one, to maintain monetary stability, to maintain financial stability, to maintain stable payments system, to promote the development of financial infrastructure of market and systems, to ensure that credit allocation by the financial systems broadly reflects the national economic priorities and societal concerns, to regulate the overall volume of money and credit in the economy. So these are all the main functions of RBI. So monetary stability. So monetary stability is very important for every organization or every country. So that is RBI is taking the main function of the monetary stability. Financial stability, that is also required, and stable payment system. It should not be a decreased one. So it should be a stable payment system is required for our country. To promote the development of financial infrastructure of markets and systems. So at the same time, not only getting money, not only stability of the financial and monetary systems, but they want to develop the financial infrastructure of markets and systems. And to ensure the credit allocation by the financial systems broadly reflects the national economic priorities and social concerns. And last one, to regulate the overall of money and credit in the economy. The overall volume of money has to maintain. That is the responsibility of the RBI. Monetary authority. Monetary authority formulates, implements and monitors the monetary policy for first point is the maintaining price stability, keeping inflation in check, that is the main duty. Ensuring adequate flow of credit to productive sectors. Regulator and supervisors of the financial systems. Lays out parameters of banking operations within which the country's banking and financial system functions for maintaining public confidence in the system, protecting deposit interest, providing cost-effective banking services to the general public. So this is the main duty. So they are maintaining the public confidence about the system, protecting the depositors, and providing the cost-effective banking services to the general public. Regulator and supervisors of the payment system authorizes the setting up of a payment system, lays down standard for working of the payment system. 3. Lays down the policies for encouraging the movement from paper-based payment system to electronic modes of the payment, setting up of the regulatory framework and newer payment methods, enactment of customer convenience in payment system, enhancement, improving security and efficiently in modes of the payment. So in all the ways they are making the very much convenient and very easiest way to make the payment in the banking industry. Manager of Foreign Exchange. The RBI manages the forex under the FEMA, that is Foreign Exchange Management Act 1999. In order to, first one is facilitate the external trade and payment, promote the development of foreign exchange market in India. So this is the two things. Issue of currency. RBI issues and exchanges the currency as well as destroys the currency and coin not fit for the circulation to ensure that the public has an adequate quantity of supplies of currency notes and good quality. Development role. RBI performs a wide range of promotional functions to support the national objectives. Under this, it set up institutions like NABARD, IDBI, SIDBI, NHB, etc. Bankers to the government. Performs merchant banking functions for the central and the state government, also acts as their banker. Bankers to bank. An important role and functions of RBI to maintain the banking accounting of all scheduled banks and each as the bankers of last resort. An agent of the Government of India in the IMF. Objectives or roles of RBI. Note issuing authority. The RBI has the sole right or authority or monopoly of issuing currency notes other than 1 rupee notes on coins of the smaller denominations. Government bankers. The RBI is the banker to the central and state government. As a banker of the government, the bank can make ways and means advances to both the central and state government and also provides overdraft facilities. Bankers Bank. The RBI can be called a banker's bank because it has a very special relationship with commercial and cooperative banks, and the major parts of the business is with these banks. Supervising authority. The RBI has the power to supervise and control commercial and cooperative banks, that is, to issue the licenses for starting branches, to suspect the working of banks in India. Exchange Control Authority. RBI also performs the role of maintaining the stability of external value of rupee. It pursues these objectives through its domestic policies and regulations of foreign exchange market. Promoters of financial system. RBI has been rendering development or promotional services which have strengthened the country banking and financial structure. Banking Abutment Scheme. RBI introduced the Banking Abutment Scheme in 1995. Under this scheme, the complainants can file their complaints in any form, including online and can also appeal to the RBI against and awards and the other decisions of the banking ombudsman. Monetary policy implementation. RBI implements the monetary policy through its various instruments. Banking codes and standard boards of India. To measure the performance of banks against codes and standards based on established global practices, the RBI set up the banking codes and standard boards of India. Customer Service Department in RBI. RBI set up a new department called Customer Service Department to carry out a variety of activities relating customer services and grievance redressal in the RBI. Fair Practices Codes for Lenders. RBI formulated the Fair Practices Codes for Lenders, which was communicated to banks to safeguard the rightful interest of the borrowers. Transparency and reasonable of bank charges. There should be a transparency and reasonable of the bank charges. So these are all the main objectives, roles, functions, whatever taken by the RBI. Next important concept is monetary policy. RBI executes monetary policy for Indian economy. The RBI formulates, implements and monitors the monetary policy. The Monetary Policy Committee is entrusted with the task of fixing the benchmark policy interest rate, that is repo rate, for inflation targeting. The main objectives of monitoring monetary policy are maintaining price stability while keeping in mind the objective of growth inflation control, containing inflation at 4% with a standard deviation of 2%. Controls on bank credit interest rate control. Fiscal policy. From the last class, how the Presidential and Congress controls the economy. Expansionary policies to increase the economic growth. Contractionary policies to slow the economic growth. The problem is government cannot be relied on to make good decisions regarding the economy. Monetary policy definition. How the Federal Reserve influences the supply of money and brings the nation out of either a recession or the inflationary period. Federal Reserves. A nation system of banks that influences and controls the economy and the money supply, called the Fed. What banks are parts of the Fed? So monetary policy means just is controlling the supply of money in the country. That is called as monetary policy. So here the national system of banks that influences the controls the economy and the money supply. So normally the Federal Reserve calling it as the Fed. All nationality chartered and most stated chartered banks are the required to join. Federal Reserve's Board of Governors. There are 7 members including a chairman appointed by the President. These governors as well as the 5 presidents of the Federal Reserve Banks form the Federal Open Market Committee. This committee establishes our national monetary policy. Appointed and not elected. The Board of Governors is appointed by the President so that they can make unpopular decisions about the economy without having a worry about being re-elected. So what does the Federal Reserve do? First one, federal government banks. Maintain a checking account for the treasury and processes payment such as tax refunds. That is the first one. Second one, government securities auctions. Sells, transfers and redeems the government bonds. So this is the second one. Issues currency, paper money. Check clearing. So transfers money from one account to another when checks are written. So that is the fourth one. Supervises the lending practices. Monitors bank reserves throughout the country. Lenders of last resort. In case of economic emergency, banks can borrow funds from the Fed. So how does monetary policy will work? By adjusting supply of money in the nation, the Fed can speed up the economy or slow it down. So how does the monetary policy will work? So monetary policy is nothing but just a circulation of money and a controlling of the supply of money in the country. So that is by adjusting the supply of money here. To get out the recession, the Fed encourages the people to spend by increasing the money supply. So that is the very big problem. To stop inflation, the Fed discourages the people from spending by decreasing the money supply. So one thing, it is recession period. So here the people is encouraging to spend more money. If it is inflation, discourages people from spending by decreasing the money supply. So this is the main problem. How does the Fed do this? Three tools of the Fed. First one, reserves requirement. Second one, discount rate, open market operations. This is the main important three tools for the Fed. Reserves requirement. They should maintain some money always in the form of reserves. So if it is lacking money supply means they can use that reserve amount. Discount rate. They should give some interest rates discount on the basis. And of course open market operations. Reserve requirements. The percentage of all deposits that a bank must keep in the vaults. That is, for example, I have $1 lakh in deposits and the reserve requirement is 10%. How much must I keep in my vault? How much can I lend out? So this is the reserves requirement. This is maintaining a problem. So vault. So $10,000 and loans is 90,000. So what if the reserve requirement goes up to 20%? So then vault is $20,000 and loan is 80,000. What if the reserve requirements goes down to 5%? 5,000 is the vault and loan is 95,000. So this is called as reserve requirement. So whenever government is lacking money, they will do this activity to get the money back from the public. How does this affect the money supply? So reserve requirement is increasing, so money supply is decreasing. Reserve requirement is decreasing, money supply is increasing. So if reserve requirement is taken, the one of the tool means, so this will happen in the currencies. That means money supply. So reserve requirement is increased means money supply is decreasing. Reserve requirement is decreasing means automatically money supply will increase. The discount rate. At times, the Fed lends money to banks. By either lowering or raising the interest rate by charge, the banks, they can influence the interest rate that bank charge their customers. So this is the discount rate. So lowering or raising the interest rate by the charge bank. So they will increase the interest rate or decrease the interest rate. So based upon that, they will take the decision. So that will give some charge for the customers. So discount rate is 2%, the bank charges 3%. The Fed decides to raise the roll. Discount rate is 3%, the bank charges 4%. Higher interest rate. Less people get loans. So this is the idea. The Fed decides to lower the rate. Discount rate is 1%, the bank charges 2%. So lower interest rate, more people get the loans. So this is how does the affect this is the money supply. So discount rate is increasing, money supply is decreasing. Discount rate is decreasing, money supply is increasing. Open market operations. When the government buys and sells the bonds, selling bonds takes money out of the circulation. Buying bonds puts money back into the circulation. So this is the effect. Selling bonds, money market is decreasing. So buying bonds means money supply is increasing. Monetary policy during the recession. So goal increase the money supply. Decreases the reserves requirement, decreases the discount rate, buy bonds, called easy money policy. So during the period of inflation, decreases the spending and money supply, increases the reserves requirement, increases the discount rate, sell bonds, called tight money policy. Once again, I want to thank Bharat Institute of Higher Education and Research for giving me this opportunity. Thank you.